Hello class, picking up where we left off in part 1 of our discussion of chapter 2 and tax credits. We're looking at higher education credits. Two specific ones, most common and used is the AOC or American Opportunity Credit and the Lifetime Learning Credit. One is much better than the other, so the American Opportunity is much better. So you want to check first with clients if they are eligible for that, and then if not, then the Lifetime Learning Credit may apply. But it's so much more of a credit if it is American Opportunity Credit. Now the AOC is partially refundable, as we mentioned earlier, and partially non-refundable. But the Lifetime Learning Credit is all non-refundable. There's no part of it. Okay. So first, American Opportunity Credit. Notice this is per eligible student. So some families may have 2 or 3 children in college. Their credits could be 3 times this. It could be $7,500 potentially, because it's per eligible student if the student qualifies. So it's the first $2,000 you pay for tuition and other expenses, and then 25% of the next $2,000. So basically, if your tuition is over $4,000 in the year paid, including books and fees and stuff like that, then you're going to get the maximum 2,500 credit. Okay. It is though phased out when your income gets too high. 160,000 starts phasing out for married filing jointly, and 80 to 90,000 for everybody else except for married filing separately. Another penalty for married filing separately, you don't get to take this credit either. So example, okay, they pay $7,700, that's plenty. Okay, he's a junior, he's in the first 4 years of school, he attends full-time. Those are the requirements for the AOC. All right, so he has first 2,000 out of the 7,500 is 100%. The next 2,000 out of 7,700, only 25%. So easily 2,500 initially, but then we have to consider the phase out. So the phase out is from 160 to 180. So we're going to reduce it by 1,563. All right, that is how much they are over the threshold. Okay, so they're over the threshold by 12,500 divided by 20,000, so approximately 63%, and so they have to phase out 63% of their 2,500. So they only get to actually claim 937, 40% of which is refundable, 60 is non-refundable. That's always 40-60 regardless of how much the credit ends up being after you reduce it for your income. Now, Lifetime Learning Credit is much less advantageous. Maximum is $2,000 per tax return. That doesn't matter. Doesn't matter how many kids you have or how many dependents you have, is on your tax return for family. So there is no, it's not like if you have multiple students you get more. This is going to be max out much quicker. It's only 20% of the expenses up to 10,000. Okay, so you only want to use this if you don't have a child that qualifies for American Opportunity Credit. Now, both of these credits are only applicable if you can claim someone as a dependent. So remember, we said that claiming someone as a dependent is still an important consideration. Here are 2 examples where if the person is not your dependent and you pay expenses for them, then you can't take the credit for them, for those expenses. So, so Lifetime Learning Credit is for anything that doesn't fit the American Opportunity Credit. So first 4 years of college, full-time student, those qualify for American Opportunity Credit. If you're in graduate school or you're only going to school part-time or something like that, then you fall to the Lifetime Learning Credit. And not only is it lower, it's phased out much quicker. Okay, 114 to 134 for married filing jointly, and 57 to 67. Again, you can't do it if it's married filing separately. So Joe paid $6,300 for daughter. Both children attend college part-time, so that means that they're ineligible for the American Opportunity Credit during 2018. Files as head of household, AGI is 61,220. So we're well, this between the two of them, we spent more than $10,000, so we take the $10,000, multiply by 20%, that's $2,000. Okay, then we have to worry about the phase out, starts at 57. All right, so he's over that by 44,120, so he's going to reduce his credit by 844, which is this formula right here. All right, subtract the 844 from the 2,000, and his total credit actually is 1156. All of the education credits are claimed on Form 8863. All right. We talk about the eligible students. All right, and the information you provide. Again, they put this in a few years ago. People were claiming things they were entitled to, so you have to give quite a bit of information about the student, make sure that they're real and they're actually paying tuition and that they're going to a real college, all that kind of stuff. And then the actual calculation is very brief at the bottom of 8863. All right, and then ends up with the amount that you're able to claim, and of course then that goes to the 1040 form with the if it's refundable and non-refundable. There's two different lines on the 1040. Lifetime learning credit, write down is the last two lines on this form. Okay. There is a part of the education credit, okay, and the phase out scenario is laid out on the form. And as far as the amount, here's the amount that total credit and the amount refundable, 40%. A little bit more about how that's going to look. Okay, if you add in your lifetime learning credit and to your non-refundable AOC, and then the threshold is all built into the form to help you calculate how much is you're going to phase out because of income. Okay, retirement savings contribution credit. Pretty rare, phases out pretty quickly, but it is a situation where you double dip, meaning you get a deduction for putting money into your 401k, and you get a credit for part of the money you put in. So it's a double whammy benefit tax-wise that is pretty rare in the tax law. Most of the time, there's only one. You can only take one benefit. You have to choose between one benefit or the other. This is a case where you could do both. So, but as you see, the amount that you can put in, it goes away pretty quickly. Meaning if you're over $63,000 of AGI, verifying jointly, you get zero of your contribution. So it starts out at 50% of what you put into your 401k, drops to 20% when you reach this level of income, and then down to 10% when you get to that one. Different ones for each filing status. Okay, notice that they only decided to differentiate between three statuses here, all single, married filing jointly, married filing separately. Qualifying widow all fit under here. Qualifying widow does not get to use the married filing jointly in this case. Okay, it's only up to $2,000, so there's no more. The maximum you could have as a credit in this is 50%. That's the highest percentage and the highest amount of contribution. So example, head of household, put $1,800. AGI is $31,000, so she's right here, just above this level, and so she can only take credit for 10% which is still $180 in taxes she doesn't have to pay. Okay, so well, it's not a big amount. It's every little bit helps. Second, so married filing jointly. Second example, 38.9. They get to do 20% of their $2,000 maximum per taxpayer. Okay, so there's two of them. 4,000 times 20%, $800. So that's $800 the credit that they would not have to pay in taxes from their tax liability. Child tax credit. This increase for 2018 is, instead of $1,000, it's $2,000. Definition is still under age 17 at the end of the tax year. It's reduced when you reach these thresholds. These thresholds were increased substantially for this credit in the new tax law for 2018. $23 or each $1,000 increment. So example, oops, we're going to use that AGI 207-300. 2 kids, $4,000. The niece is a qualifying child. Over 200,000, so we take this difference, we divide by 1,000, we get 7.3. We always round up, and so that ends up being 8 times $50 for each increment. So we get $400 reduction. So we take the 4,000 minus the 400 equals a 3,600 child tax credit. So if you don't have tax liability, or you have a low tax liability, so you cannot use all of your child tax credit as a non-refundable, you can. There is also a possibility of using it as refundable, but only if you have earned income. If your earned income, you can only do it up to the 15% of your earned income in excess of $2,500, with a maximum of $1,400 per child. So 3 kids, okay. Actually, let's do that with 2 children. Let's change that example to 2 dependent children, okay. AGI 34,860, all of which comes from wages. Their tax liability is 2 to 1. So first of all, we use the child tax credit to offset the liability. So the first 201 is non-refundable. That covers that. Then we do the next calculation, okay. It's either the 4,000 minus the 201, the remaining 3,799, but that can never be more than 2 times 1,400 because they have 2 children. $1,400 is the maximum refundable per child. So that would be 2,800, or the other limit is 15% of the amount of our earned income over 2,500, which is much higher. So this limit doesn't apply. This limit doesn't apply because this one is lowest. So we're going to choose the lower of the 3. All right, and that gives us a 2,800. The additional child tax credit is claimed on Schedule 8812. Okay, the information, process, computing, all here at the top. Okay, and we're not going to go over too much at the bottom with 3 children because that's a little more complicated. It takes you into account Social Security taxes and so forth. But the process here is basically to see if they're over the threshold, okay, and make sure that they reduce it if they are over the threshold. We'll look at the remaining credits in our part 3 of this podcast.